Good afternoon and welcome to another PKF Francis Clark budget webinar. We have a new government and a new Chancellor, but some things remain constant in a changing world, and I'm pleased to say that with me today to discuss the announcements made yesterday is PKF Francis Clark's Head of Tax, John Endacott. Good afternoon, John.
Good afternoon, Gordon. I'm glad we're both here together.
Yes, so am I. Looking forward to it, and a very warm welcome to all our guests. We're delighted that so many of you have joined us again, having been attendees on our previous webinars, and also to welcome many of you who are joining us today for the first time. We know from the number of people who've signed up to this webinar over the last 24 hours that there is a huge amount of interest and indeed concern about the measures announced yesterday. So we will be taking a deep dive into those and also giving you an opportunity to ask your questions to John. So if there is anything as we go through the webinar that you would like John to address, please do post your questions in the Q&A, and a bit later on we'll get around to picking up some of those. Over the next 45 minutes or so, our plan is to talk about employers' national insurance, the changes there, and also the impact on profit extraction for business owners. We'll take a look at the changes to capital gains tax and how they will affect people. Another hot topic, of course, at the moment is inheritance tax, so we will come on to that later. And of course, as I said, we'll be answering some of your questions a bit later in the webinar. So, John, just to kick us off, I think one person who's been perhaps busier than you over the last 24 hours is Paul Johnson of the IFS. He seems to have been on virtually every TV and radio news program going. I have a quote from him yesterday. He says, "It does bear repeating that the fiscal inheritance is truly dire. The spending plans inherited from the last government were never likely to survive contact with a spending review. Tax rises were always a near inevitability." And people who were with us in the spring on our last budget webinar will remember that you were making the point then, I believe, that the general direction or the likely path for taxation was upwards. Looking at the measures and the changes announced yesterday, how surprised were you by both the scale of the tax increases, I think around 36 billion a year, according to the Office for Budget Responsibility, and also the way in which Chancellor Rachel Reeves went about that?
Thanks, Gordon. So, yeah, the budget's been widely hailed as the biggest tax rising one since 1993, one I remember quite well, and seemed very painful at the time. And that went after people like company car drivers, and it went after the ordinary person much more. That the difficulty here, and the bit that we're all trying to absorb and understand where we're going with this, is that we have a government that was elected on a basis of the target being growth, and that everything else would have to follow on from that growth. And yet, what they have done is to load a whole load of tax liabilities on the business sector and on the businesses that need to drive that growth. And as a result, the figure suggests that those businesses won't be able to produce the growth that they would otherwise have been able to produce. And that just seems a bit odd.
Mm. Okay. Well, one of the main, the biggest revenue raiser yesterday in fiscal terms was, of course, the changes to employers' national insurance, raising around £24 billion a year. Should we come on to look at that and the implications for businesses and business owners? I
Yeah,
think we've got some slides here that will help to illustrate the points that you're hopefully going to make.
Let's start there. And just whilst you're bringing that up, you know, we're focusing on some particular tax changes here, which are the ones that we think have got the most resonance with everyone and the most important ones to talk about. Very happy to take questions on other ones and to pick up on some other points. So don't think we're very interested if you've got something else to ask about. But let's start with employers' national insurance. So widely trailed, widely explained, and we knew that something was coming. A lot of issues on this about whether it would be challenging the salary sacrifice arrangements, where we've got legacy issues where certain things are subject to employers' national insurance and certain things aren't. And life has moved on a lot in the meantime. So pensions are a good example, which are quite well favoured by the legislation at the moment on that. And there were suggestions that the government would go after that, which you could understand that would even things up. Instead, they stayed away from all of that, and they've gone for a straight increase in the employers' national insurance contributions. But what is startling, never mind the indications that were coming out over the weekend and before, what is startling is I'm going to call it a poll tax, because basically the big increase comes on dropping the threshold down at which employers' national insurance is levied on salaries of members of staff. So on the face of it, an increase of 13.8% to 15% is a 1.2% increase. You know, you can take a payroll, you can multiply it by 1.2%, and you go, so be it. You know, and I've been doing those sums for the last few weeks on the payroll of a well-known accounting practice, you know, and you think about what that means and you deal with it from there. But what's very marked here and causes the issue is that actually that isn't where the big money is raised. The big money is raised by creating, dropping the threshold down and levying 15% on 4,100 on pretty well everyone working in the UK, where it wasn't being paid before. And so you end up with an extra £615 per employee. I mean, I appreciate there's some part-time people and some people will be below the 9,000 threshold, but for ease for a moment, you know, if you just start from the premise that it's pretty well everyone. And what that means is that this measure really, really hits those people with large workforces where they are at the lower paid end of the spectrum. So the hit is far worse if your employees are earning 25, 30, 35,000 than if you've got lots of people who are on many hundreds of thousands of pounds a year. There is an increase in the employment allowance. The employment allowance is going from 5,000 to 10,500. Broadly, the way that works is it means that businesses with less than about 10 employees probably don't feel anything or don't get much of a hit on here. So the very small part of it is protected. And so if you picked a small cafe in whichever town you're in, that's been run by an owner with some members of staff, actually probably this isn't an issue for them. But if you go to a 3-star hotel, or you know, someone with, you know, a couple of restaurants or something like that, you go to all manner of other ones a bit bigger or trying to run things, you go to most of the service sector, and it is a very big bill coming around that's got to be found, and it's got to be found with 6 months notice or less than 6 months notice. So the numbers are marked. And then what is frankly absolutely staggering is to then push up the living wage at the same time and to hit things like a 6.7% increase on that, an even larger increase on the younger workers. And where this then gets down to is that employees that are more marginal are the ones that you're going to look at. Now, I appreciate I just talk like an accountant, and I'll talk about, but you know, that's the show you signed up for, so there you go. But I'll talk about, you know, profit per worker or something like that, you know, earnings per worker. And people that earn less will generate less profit on the whole. I mean, that's just the way it works. And so what you're doing is you're making it far less attractive to employ young people. You're making it far less attractive to employ trainees. You're making it far less attractive to take people who might have not been in the workforce for a number of years and are therefore a bigger risk for you. And that's before you get to the employment law changes and all of those things, which are a bit harder to work out the precise impact, but they're not exactly motivating people to expand their workforces. So this is, you know, there's pretty well every business owner going is going to be looking at this at the moment thinking, where are we going with this and what are we doing? And it will drive people looking at more automation and other kind of factors like that. It's quite surprising a decision to make.
It's interesting also to bear in mind, John, that in the spring, after the spring budget, we were talking about a 2p cut in employees' national insurance announced by Jeremy Hunt, the previous Chancellor, which followed, of course, the original 2p cut in the autumn statement around about a year ago. So the overall cost of both of those measures was around about 20 billion. As I mentioned, the OBR suggests that the employers' increase announced yesterday will raise around 24 billion in future years. So I guess the overall effect of what we've seen in the past year is a transfer of around 20 billion pounds of taxation directly from employees to their employers. It was interesting that Rachel Reeves yesterday described the 2p cut in the spring as the height of irresponsibility, although the Labour government pledged not to reverse those cuts in the lead up to the general election. So, I mean, were you surprised by that, or what will be the practical implications in real terms about who does end up paying? Because I think the OBR suggested that employees will ultimately end up footing the bill for the majority of this. Is that correct?
Yeah, so let's take up a couple of those ones. So yes, when we were chatting in March, we were looking at this thinking, "Whoa, that looks difficult to justify, and it could end badly." And it seems to have ended badly, albeit somebody else in the driving seat now. The discussions around employees ultimately bearing the cost, a lot of that is in higher inflation feeding through. Because, and if you look at what's a position that we can do as a firm, well, we can put prices up, we can recruit less people, we can squeeze down on future pay rises and other benefits that we provide to our staff. I mean, and the reality is that you're likely to do all three of those, or try to, to the best that you kind of can. The ones that really bother me is there are many businesses who are going to struggle to be able to recover that in terms of additional costs. If you look at places like the care sector that we've spoken about, in some of the posts we put up, nurseries, that it's not easy to see that they can put their prices up much. Hospitality sector is going to struggle. So it looks inflationary as a measure. I mean, the budget looks inflationary full stop. That is likely to mean that interest rates stay higher for longer. It's got all sorts of risks that kind of go with it. And you've mentioned the IFS a few times. Helen Miller's spoken quite a bit about this rather than Paul Johnson, on the position that employers' national insurance is quite a hard one to work out where the incidence of the tax really ends up at the end of the day. And over time, this will get absorbed and factored into, and people will accept the additional on costs that they've got to kind of go through. But it will be a painful process of absorbing that, and it may not raise as much money as all that for the government in that meantime. So that it's a lot of eggs in one basket.
As you say, the impact is, in percentage terms on a payroll, it is greater the more lower paid employees a business has. The OBR, I noticed yesterday, assumes that the impact of this increase in employer national insurance will be to cost around about 50,000 jobs, which I don't think I've heard that mentioned yet much in the media. But you were starting to talk about the sectors and the businesses that you think where we might see that impact.
Yeah, I mean, it's difficult, and the danger is that you get into, I get into sounding like, the kind of grim reaper or something, and we get very Halloweeny, or very accountant like. I mean, some of the ones that I think is that the difficulty is there's both sectors, but there's also, it will make the employment market much harder for, let's say, graduates coming into the market in the next year or two, or younger people kind of, so it has particularly adverse impacts on certain people trying to get into something. It's just quite startling.
Mm,
And
mm,
I think, many of the business on this call, as well as us and the rest of it, we can help, it's just good accounting stuff in terms of looking and understanding, but the circumstances will vary by business as to how to approach it. It is a very, very significant additional cost that a lot of businesses will need to absorb in 25, 26, and they need to be exercising their brains as to how they're going to get that to work.
What sort of conversations then will you and our colleagues be having with clients about this issue in the near future?
You'll be going through in terms of pricing decisions, what the scope is for the market to push up, because it's a widespread impact affecting entire sectors. Then you're going to get to a position where actually, you know, it it's not that you've got to worry about the competition, it's what the market can sustain rather than worrying that you're going ahead of the competition. I think people will be nervous about recruiting. I think people will be looking very carefully at what pay rises are being awarded. All of those things, which are conversations that go on normally. But one of the difficulties with the living wage increases is that differentials for people earning above the minimum wage have been very badly squeezed in the last few years. And we were largely hoping for a bit of respite to try and restore those differentials and get to some better pay progression going on. That will be harder with what is going on here, and that will cause its own difficulties in terms of motivating and trying to have people, So
I see.
should we? Yeah, I think I'm worried that I wanted to sound more upbeat, and you're going to keep me being too gloomy at this point. So I think.
Okay, John. Well, we'll see what we can do about that. But yes, let's move on. Before we leave national insurance behind, there's another aspect of it is the implications for business owners in terms of their own remuneration and the impact this has on the calculation that they might be making between paying themselves by way of a bonus or a dividend. I think, did you want to make some comments on that question?
Yes, please. Yes, please, Gordon. So, I was up crunching my numbers this morning, and you can tell how much harder the UK tax system has got over the last 30 odd years by how much harder it is to do these calculations than it used to be. And there's a lot of assumptions that you have to start to get into now, and some things that differ. But broadly, for higher and additional rate taxpayers, so those earning over 50 grand a year or with incomes over 50 grand a year, if you're looking at whether you take money out of a company by bonus or dividend, it's pretty marginal, the difference between it, which was the position before. And the 1.2% move will should skew it slightly further in favor of dividend, but because bonus was looking better, it's just there's not much in it, and bonuses look pretty sensible. So taking money out and all of that seems to work okay. The question is when you come down to the basic rate taxpayers, and this is harder because there's more variability that can come into the numbers. And I've had conversations with a number of our partners where we have to be very careful about picking up some of the numbers at this level. But broadly, if you're paying corporation tax at 25%, so the big company rate, and let's ignore the marginal rate for a minute, then there isn't much difference between bonus or dividend either. But for smaller companies, so let's say you might have a number of personal service companies or other things like that, where they might be paying at 19% or in the margin with it working up, then a dividend looks much, much better. And if you then move on to saying, well, you might have husband and wife sharing in that, then it hugely incentivizes trying to use companies to extract, trying to use dividends to extract money from the company. So structuring businesses between, let's say, husband and wife or between two people and pulling the money out by way of dividend, which is something that various governments have tried to get away with or get away from over the last few years and try and get rid of these distortions. And that distortion's just been made much worse, which is why one of the things that was featuring in the budget statement was even reference to umbrella companies, between targeting promoters, between upping the ante on HMRC activity. So because the government has gone after employers' national insurance as a way to raise the money, they've almost got to put more police and more other people in and more activity into just policing something than if they'd gone for just reversing, let's say, employees' national insurance, for instance, or something like that. So it's a tricky area, but for broadly people on higher levels, higher amounts of money, higher earners, you know, bonus probably makes the most sense if you're taking money out of the company. For people within the basic rate, there's a lot more numbers to crunch, and you need to speak more properly with the accountant in your personal circumstances.
Right. Okay, John. Thank you. I'm sure that'd be helpful for many people. Were there any other points you wanted to make on the national insurance changes before we move on to talk about some of the other measures?
I think let's see if we can find better news.
Okay, then. Well, the other announcements yesterday on the capital taxes front are forecast to raise around 6 billion a year. The main components of that will be the changes to capital gains tax and inheritance tax. We'll come on to inheritance tax in a bit, but first of all, on capital gains tax, John, please could you talk us through what changes were announced yesterday? And there are quite a few numbers on this slide. I realise that perhaps not everybody will be able to read them depending on what kind of device you're watching us on. So perhaps it would be helpful as well just to sort of talk through the point that this slide is making here.
Yeah. So at the moment we have sorry, at the moment, no, before budget day, we had a distinction between whether you had shares in a company or commercial property. We had a distinction between what the tax rate was on residential property. We had a different regime of CGT for carried interest, which is to do with private equity mainly. And then we had two separate reliefs for two different limits running on them, called business asset disposal relief, which used to be entrepreneurs relief, and then something called investors relief. And those rates started from, as low as 10%, which looks quite a low rate in the current climate and has done for a little while. So if you want to say that all looks a bit of a mess, it all looks a bit of a mess. The government has done what one thought they probably would do before they wound everyone up across a lot of the summer, which is they've gone for a 24% main rate, and they've got rid of these distinctions so that we will have one main rate of capital gains tax, and that will apply whether you've got shares in a company, whether you've got commercial property, whether you've got residential property. So a number of the issues that we've been dealing with for the last few years about what if you've got a shop with a flat above and how do you calculate that, and all this unnecessary kind of complication disappears out. What it means is that residential property didn't get hit at all by any capital gains tax increase, and so actually landlords came out of yesterday, relatively well unscathed from yesterday's events. They might feel beaten up by the last few years, but actually, it's interesting the way it came through, and people with holdings that were non-business holdings relatively came out not too bad. Now, what is interesting beyond that on it is for residential property, before the budget, we had an 18% basic rate band and a main rate of 24%. And this basic rate band is using up the rest of your basic rate band for income tax. So, if you've got if you're on a salary of, let's say, about 27,000, you've got maybe 10,000 left unutilized, and therefore you could have a capital gain within that kind of band or whatever, depending on how you're dealing with your personal allowance. So that's how that bit works. What's being done is for non-residential property and for shares, it's equalized with residential property. For the main rate, you go from 20 to 24%. 4%, most people feel could have been a lot worse. That's not too bad. We can live with that. Let's get over it. Interestingly, if you've got a company where there are lots of basic rate taxpayers, so let's say you had lots of basic rate taxpayers and they've all made a gain of 25,000 and they didn't have much other income, proportionately, they've been much more hit by yesterday's increase, because the basic rate's gone from 10 to 18. I mean, not quite doubling, but an 8% increase, 80% increase, as opposed to, 4 over 20. So you get to some quite sharp ones there. For anyone who was busy trying to sell assets in advance of the budget in case capital gains tax was going to go up, if they were dealing with non-residential property, commercial property, or shares in companies, then they called that right and they made the right decision. Is it livable with where it's got to? Yes, it is. If it went any higher, would it really cause problems? Yes, it undoubtedly would. I mean, I worked all through the Nigel Lawson experiment of equalising capital gains tax and income tax, and the damage that did to the economy was immense. The economists favour it, but they're not accountants, and that's up to where they want to kind of go. But it causes real problems. Bear in mind that these tax rates tax inflationary gains, and over time you will get to large inflationary gains. Even in the last couple of years or so, you've got cumulative inflation of north of 20%. These rates do damage in terms of disincentivizing people. When you come to carried interest, that has been pushed up to 32%. And then from April 2026, it's going to be taken out the capital gains tax net, and a new, more complicated income tax regime is going to come up with that will end up with a number that's about 32%. So there's been a deal kind of done then up to a point of something that the private equity industry can kind of accept. When you come to business asset disposal relief and investors relief, they will both now have a limit of £1 million until until April. We've got a 10% tax rate, so there's an incentive still to get certain gains through and companies sold for those people in that position, but it's not that big a number. And then next year it goes to 14%, and then after that to 18%. So what we're going to get to is owners of businesses who are actively involved in them and meet the qualifying conditions after 2 years can effectively get £1 million worth of basic rate band, and then above that everyone's paying the 24%. It's livable with, it's okay.
So on that final point, John, what sort of conversations do you think our colleagues in the corporate finance team will be having with business owners who perhaps had been considering selling their business in the next few years?
I think if you go through the maths, it's unlikely to be a number that's enough to incentivize someone to want to accelerate a transaction unduly. What we will see, even apart from business disposals, is succession arrangements. So a lot of work we do where people might want to trigger a capital gain, and we've had a lot of that running up to the budget and so far this year in various ways. You can see an incentive for people to want to get to a position whereby they're passing things on, because if you're going to do something next year, for instance, or the next year or two, it's probably worth doing it now. But you wouldn't necessarily want to cash in your chips just because you might get 4% on £1 million.
Okay, I see. I mean, that is one of the points about capital gains tax you were making there, that changes in the rates or anticipated changes in the rates do have behavioural effects. So I think there have been reports in the media in the lead up to the budget of a lot of people selling assets to lock in existing capital gains tax rates, which from a government point of view obviously brings in a short-term spike in revenue. But then if people have brought forward sales that may have been happening in the next few years anyway, would you expect to see receipts drop off after these changes take effect?
You very possibly will. I mean, that's what we've been doing for the last umpteen months, is dealing with a large number of transactions and pushing them through. There'll be lots of lawyers and other people on the call. That's what's been going on, the nature of it. That the difficulty with capital gains tax is, you look at the risks that people are going through. People set up a business, they invest in things because they want to get a return. This is the government shaking people down and saying, we want a large slice of your return. And by the way, just so we understand, if you lose a whole load of money and that doesn't work out, that's your problem and you don't get any relief for it, kind of stuff on the whole. Yeah, it's it's pretty unfair and heinous. And but that's spoken as a business owner and people trying to look at how things come through. You know, it's easy for people to say you can contrive salary arrangements to look like capital gains. Yes, you can, up to a point. But then the government should target those. The danger is this is, again, if you want to encourage growth, you would have cut capital gains tax. You know, I mean, we know what needed to happen. You certainly would have left it alone. This is just okay. Yeah.
Okay, thanks, John. Just on the carried interest changes for anyone who is interested in that topic, we don't have time to get into that here on this webinar, but if you are interested in finding out more about that, our colleague Youssef Toumi has written a blog which you can find on our website in the Budget Hub, and we'll be following that subject going forward as we respond to the ongoing consultation on those impending changes. So, John, that's a bit about capital gains tax. Any other points to make before we move on to inheritance tax?
No, let's move on to inheritance tax. But thank you for mentioning the blogs on the website, and there are some other brilliant ones on there as well by some very clever people, and it's well worth reading.
Absolutely, yeah, it was a great team effort yesterday, and we've got some great content on our website if you haven't already seen it. So inheritance tax changes obviously will be on a lot of people's minds today, as we know. John, just set the scene for us in terms of the context of inheritance tax and how it's been working. For anyone who can't see this graph, it's showing the average effective inheritance tax rate on those estates which are affected by inheritance tax over the last 8 years or so, from about 2016 up to 2022.
Yeah, so I mean, this graph is, you know, it's a good place to start on this topic because this is the one that's been driving a lot of behavior over the last few months and has been pretty clear over the last couple of years or so by the people kind of promoting it that you kind of knew where you were going. So what this graph is all about, and the bit that causes big problems with members of the government and the key lobby groups that support them, is the inheritance tax regime. People want to be progressive. So what you want is a line that goes from the kind of 0% end of the, you know, the left hand side and goes up diagonally, so it's going from, you know, bottom left to top right. What happens is, and these are real numbers, so these are numbers from HMRC, it's HMRC's graph, this is people have actually died, the figures returned on their death estate, and they crunch the numbers. And what happens is, other than some oddities to do with the way some of the release work and as some things come through, particularly to do with when the residence nil rate band was being increased, the graph, the line largely goes up from 300,000 to about 2 million. So estates up to about 2 million, the relief is largely progressive. And it hits estates a bit north of 1 million, you know, relatively, people start to feel the pain quite quickly at that point. Then it flattens out above 2 million, and then it drops down again, and you get to a much lower rate on larger estates. And this really, really winds certain people up, which is why there was all the suggestion that this is where they would go. I mean, it's confused by other kind of aspects, but this has been driving it, and we can go through the people promoting it. But so that's a starting point. Shall we go on to what happened?
Yes, please, John. Okay. So
Yeah,
talk
otherwise
us
I'm
through the
rambling on
changes.
about graphs, aren't I? You know,
Yeah,
and getting
no, that's
excited.
that's quite all right. So yes, we know already from some of the conversations our colleagues have been having with clients, particularly in the agricultural sector, that there is a lot of concern about this. Please, John, could you just talk us through what the changes are to agricultural property relief and business property relief?
Okay, so the the reason why the graph drops so much on the right-hand side is because of reliefs on estates, and those reliefs are agricultural property relief and business property relief. Those are reliefs that were introduced in 1976. They were introduced because of the impact that Labour's regime in the 1970s was having on family businesses. And throughout all of the Maggie time, and the maximum rate of relief was only ever 50%. You know, you didn't get as much relief as you get now. And for those that can remember, in 1992, John Major went to the country and no one thought he was going to win. He was nailed on to lose. And he said, if I win, I'm going to up the relief to 100%. And he won and he upped it to 100%. And then nobody's gone near it for 32 years, despite endless amounts of time in that when we're gone, they're going to go near it. Now, people have looked at the graphs, they've looked at the data and they've gone, yeah, we're going to go after it. Now, it's interesting in many ways. I say interesting in a tax technical way. If you go to the Red Book figures, this change is not expected to raise significant money. If I say the same amount as abolishing the furnished holiday letting regime, you know, £500 million a year type stuff after a few years. So it's not seen as a big money raiser, which is odd if you look at some of the reaction and what other people are saying. So one of the first questions there is, who's right on that? And it's a bit early to try and conclude too much. Possibly it's because the government expects people to take quite a lot of action to manage their inheritance tax bills, which they can do. So the answer may be that on the face of this looks like a very big increase, and then actually isn't, because there's plenty of things that people can do. But what is happening? Sorry.
No, carry on, John. Sorry.
No, that's fine. So what's happening is you will get 100%, but only on the first £1 million. And then above that, you're down to 50%, which is still an effective inheritance tax rate of 20% on that. And the government's saying, well, that feels quite good to us. They may not be the ones paying it, of course. So that's where you kind of get to. Now, this applies to individuals and trusts. And we can come to the regime that applies to trusts, and that's more complicated. Applies to individuals. It's not transferable between spouses, and it will apply to lifetime gifts after the 30th of October. So one of the conversations that Gordon and I had even before this is, well, this is a regime that's changing from April 2026, but actually it's relevant now, because unless you're intending to die, you know, before 5 April 2026, if you've got a gift of some assets going on now, you will need to be thinking about how this works.
Well, that brings us on quite nicely, John, to that very question. What should people be thinking about right now?
So yeah, and this is so these are very immediate comments, and I appreciate the, you know, it may not be where people want to go, but some ones just to start thinking about. So existing wills, there are many wills that you will see that say things like, I leave all of my assets that qualify for business property relief or agricultural property relief to Gordon. I'm not sure I've got any Gordon, so don't get too excited. But yeah, they just say that you leave it, and that's been predicated on the basis that that is fully relieved from inheritance tax, and therefore you can leave it as a legacy outside the main residue. Doesn't matter. You leave it on a first death, it's all kind of gone across. Now, based on what we're looking at here, if you've got a high enough number, that's going to mean an immediate inheritance tax hit on that first death, which isn't what anyone intended. Or depending on the way that's worded, you could mean a gift still to happen and it doesn't happen because of the way. So there is quite a bit for people to think about. How have they drafted their wills and what do they need to do? And that's just understanding the impact on you, and is an important thing to start on. Another very immediate one to start thinking about is, well, there could be members of the family who've died in the last 2 years. They might have left business assets or agricultural assets to a spouse, for instance, you know, civil partner, wife, husband, and therefore not had to worry about inheritance tax. And now it may be sensible to vary whatever arrangements were entered into in order to take advantage of the relief that is currently available. You've got 2 years from the date of death to enter into a deed of variation. It does take a little bit of time to do. There's quite a bit to think about. So, there may be action that people can take where they want to revisit things that already happened. Certainly a good one to think about. You then get to where people might have assets in trust. Now, that's a real answers on a postcard in terms of, is it good or bad to have assets in trust at this point? I would think it's probably good in many cases, but it all depends what you're after in life. And one of the things is that you may want to look at whether you're trying to break trust now, because you're worried about what the impact might have. And so the way the tax regime on trusts work for inheritance tax is that you can have things called exit charges, and you can have 10-year charges. And broadly, you need to do quite a bit of planning for when the 10-year charges come up to make sure you've got the right cash in there, particularly if you've got trusts that might have, let's say, agricultural property in or shares in a company. So they're not readily liquid in terms of it. So I've tried to do some rough numbers here because I think there's some people need to be careful not to get alarmist and to stop, take a breath, do some numbers, think about what happens here. So you'll see some comments flying around, and some of them are a bit more. So I've taken 2 million quid in a trust, and assuming we get to some of the kind of ways here, quick numbers at 6%, I get to an 11 grand tax charge. Well, I don't think that's bad. I think you can deal with life there. You get a 5 million, suddenly you got to find 100 grand. You get a 10 million, you got to find 250,000. So the issue here is high value trusts. It's not trusts in general, and it's to do with the composition of the assets in there and the fact that people haven't planned for it. And we get back to, these are rough numbers based on what we know at the moment. There's more detail to come out, and there's lots of kind of assumptions that you can work through. So there's something to think about there. The other immediate one to think about is whether you want to do lifetime gifts now, and to think about those before next April. And in my best Blue Peter, I tried to do a few numbers earlier. I mentioned life cover. I'll come back to that in a minute. Just need to remember to come back to that.
Should we look at an example then of a gift that a family farm might want to make? So I think,
and assuming
again, it'd be probably helpful here to talk through the numbers in case people can't see them clearly.
I will talk through the numbers and I'll explain it a bit more because some of this people are less familiar with, and therefore, it is quite fascinating how misunderstood inheritance tax can be by a number of people. So I'm assuming here we've got a gift of farmland and we do it on the 5th of April 2025. Could happen. I suspect there will be gifts of farmland on that date. And I've picked £5 million as my value of farmland. So, a big enough number that I think would cover a decent size kind of farmland. So, and what I'm then assuming is what happens if somebody dies. I've tried to time my gift so that the time periods of the 7 years fall neatly into tax years, which is why it kind of runs like that. So as ever, I'm trying to simplify down and get to things that are easier to kind of convey and show. And so what I've looked at is what happens if somebody dies within 7 years, at each point during that 7-year cycle. So, you've got we've got the 7 years running across from left to right. So the gift remains the same, whatever. And then we've got the 7-year cycle. And then I've looked at agricultural property relief. We're just assuming agricultural property relief here, no business property relief of any sort. And of course, the first point is your first year of that is before the new rules have come in. So you're okay on that first year. Now, one of the key things on this is that assuming you've made a big enough gift and you're above the nil rate band, you get something called taper relief after 3 years, and the tax tapers down over that time. It's the tax that tapers down, not the gift. That is always misunderstood. So, but So if you do this and you did the gift very early on, part of your 3 years, and frankly, if you did it tomorrow, about half of your first 3-year bit, you can get whilst the existing rules are still in place. You then get to a position where you've got APR limited to £1 million and then 50% of the balance above it, which I made 3 million on 5 million. Hopefully I've got that bit right. You then take 40% on 2 million quid, you get to 800,000. And I've done the effective rate of how much tax you're paying on 5 million quid. So 800 over 5 million gets you to 16%. Now, 800,000 looks like quite a lot of money to find. I get that. After 3 years, you're down to 640. That's still quite a chunk of change. 480, I mean, these are big numbers still, but at the 5-year point, you're down to under 10%. And by the time you're getting to years 6 and 7, you're getting down to numbers that may not be nice, but I can use language like manageable, or you can kind of get there. Now, obviously, it depends upon people's circumstances. But farmers are remarkably healthy people because they get up early and they go walking around outside a lot. They do handle some dangerous machinery. I'm not saying, it, but many will live to good ages. And life cover, might be a good option in terms of because if you can shorten the time period that you're trying to cover, and you're worried about death cover here, not critical illness, if you're getting down to 4 or 5 years and you may not try and insure the full amount of the liability, you could do inter vivos over that period where it declines down. You could do flat, but if you were trying to do 400,000 or 500,000 pounds worth of cover for 5 years, that may be an affordable cost. You weren't planning to pay it, but I think it's just trying to understand how you manage and other things that we do and tactics we use elsewhere and how you apply it to these circumstances.
Okay, thanks, John. Plenty of food for thought there. While we're on this worked example, we've had a question from our audience, which might be worth taking at this point. Is there any change in the 7-year rule? Mark wants to know. I think there was speculation before the budget that the 7-year rule for gifts could be increased to 10 years. Was it? Any change on that front?
There's no changes that we've seen. I think these are all things that people could come back to. I mean, one of your questions has got to be that, is this the end of it, or have we got more things to come in future? And if I was a betting man, I'd say there's more to come in future. One of the comments I should have made right at the beginning is that the government has done a fairly, they've picked a few things they've changed which have quite a big financial impact, but they haven't fiddled around all over the place. And no, they haven't gone there. So at the moment, the rules all stay largely the same as the rules were. What you've got is a change to business property relief and agricultural property relief. But things could change as time goes on.
Okay, thanks, John. Well, shall we move on to, you've talked about the short-term actions that people could be taking or discussing with their advisors. What about the sort of more medium-term considerations?
Yeah, so just picking up a few points here. I mean, we do quite a lot of work which is connected with valuation. Clearly, value of assets like farmland has a market value that a surveyor would come up with. Got to be honest and say, I would have thought that these changes might have an impact on agricultural land values and they might reduce. So that's a different kind of order of magnitude. But there is plenty that we might often do in terms of impacting on the value of assets. And if you go back to the pre-1992 scenario, it was very common to have leasehold interests over farmland in terms of reducing the value, and you had a mixture of corporate and leasehold and lots of hideously complicated stuff that I spent much of my working life unpicking, and I'm not keen to go back to. But there are rule books that we've got as to how to approach this. If you've got corporate structures, and I've said consider incorporation, so this isn't all just about the agricultural sector. A lot of this is about the business sector, and where we were talking about things like agricultural land beforehand, you could be talking about a hotel owned outside a company. There's plenty of other assets we could be getting down to, although a hotel outside a company would already have had a lower If you had a hotel owned outside a partnership, for instance, you could get the same impact coming through. But we do a lot of work whereby we might reclassify shares. We would amend the articles to restrict the market for shares, which in turn reduces their value. Typically, we might restrict shares so that they can only be transferred within a family. Therefore, that depresses the market value. It stops things being marketable. We do a lot where we'd have separate voting classes, capital rights, or free shares. All of this is, frankly, head scratching, really quite complicated, good for fees, I have to say. Whether it's economically useful for the country as a whole, I'll leave other people to judge. But there are a lot of things that we tend to do, even on more traditional arrangements. Family partnerships, considering how the partnership agreement is structured, what you do about that, putting in place pre and post nups, how that ties in with wills, what you do about spreading assets across the family. There is a whole gamut of detailed stuff to go through. I think what we're seeing this morning and last night is a sector and some people adjusting to the fact that many people are going to have to address these issues, which we would normally be doing on businesses that don't qualify for business property relief. And the only thing I can say that's more good news in that is that has been a very, very bad cliff edge for a large number of clients. It's had a big impact on their businesses. And that cliff edge is substantially altered now. So the playing field is definitely more level. It's just not a very nice playing field.
Okay. Well, thanks very much for your thoughts on all that, John. Were there any other points you'd like to make on inheritance tax before we take some questions from our audience?
No, we haven't mentioned pensions, and one of the ones I would say is that the changes on pensions are larger than the in terms of financial impact of what is expected to be raised from them, and they will have some quite nasty impacts for some people, and that is something that we will increasingly be picking up, and our colleagues in financial planning will be picking up a lot more. So I don't want anyone to think that they are unimportant or I'm downplaying them, but we've been speaking for quite a while here, and there's quite a lot to get through, and I've tried to focus on the things that I think are most relevant to some of our clients.
Absolutely. Well, on that point, our colleague Steve York has written a very useful blog about the changes to capital gains tax and inheritance tax, which you can find on our website again. So please do take a look at that. So John, we've had a few questions coming through, particularly on inheritance tax, some of which you may have covered as we've been talking. Some of which may be a little bit technical for everybody on this webinar right now. So perhaps we can, if we have your contact details, we can get back to you offline, or you're very welcome to contact us directly. But John, just looking through here, can you confirm that a farm transferred between spouses on the death of one is now going to be liable for inheritance tax?
Well, if it's transferred between a spouse, then you'll get spousal relief and there won't be a liability at that point. So you just get spouse exemption.
Okay, thank you. Could the method for valuing shares in family businesses be critical?
Yes. And one of the key things there is it's not, we get into a whole world of technical detail that keeps me occupied. But if you put a valuation mechanism in a shareholders agreement, that has a different impact to if you put a valuation method in the articles. So it's not even just a valuation method, it's legally how that's applied. Yeah, so there is a lot of detail that you get into about it, but yes.
Okay, thanks. One here, which again, clearly, as you say, there's a lot of detail for us to get through on all these changes. But somebody would like to know, will forestry be treated in the same way as agriculture?
Oh, there's an interesting kind of one.
Sorry to put you on the spot here.
No. Well, forestry is just particularly complicated because of the number of different regimes, and I can even remember the old schedules for it and the abolition of a lot of that. Yeah, it hasn't tended to feature in it. I can't see why forestry would be kept outside. Yeah, it's interesting. To be honest, I haven't looked, so I wouldn't want to start giving. Happy to probably pick that one up a bit more, just not one I've probably kind of got to in that time, but an interesting point.
Sure, fair point. Okay, as I say, people are very welcome to contact you or their regular PKF Francis Clark contacts directly, and we'd be happy to answer any questions or concerns. Um, I think you may have touched on this earlier, John, but the relief for direct descendants as opposed to spouses and civil partners, somebody would like just to clarify whether it's up to 500,000 or 1 million. Do you have an answer to that off the top of
So
your head?
so the way it works is you have the normal nil rate band, which is 325 each, and that goes up to 650 for a couple if they've both got it available. And then you also have something called the residence nil rate band, which is a ridiculously complicated arrangement that the Conservatives came up with, which takes that up and can use up the other 350, so 175 each, and get you to the £1 million in total. But there are restrictions around the way that works, and it is restricted where the estate goes above £2 million, and that is £2 million before claims for relief. So how you organise assets between people and how assets are passed on is very relevant, and we spend quite a bit of time on that because there's a lot of money at stake on that one. 40% of 350 grand is 140,000, and you can often, if I say you can often benefit from that even on about the day before death in terms of making kind of changes. The world shouldn't have to be this complicated. But yes, it can make a difference, but there is a lot of detail on the circumstances to try and plan around to make sure it's got right.
Well, it's a good point you make there, John. It is very complex, particularly as we've been focusing here on agricultural property relief and business property relief. They, of course, interact with other reliefs that may be available. So definitely worth something that's definitely worth taking advice on. Just a final one, I think, here on inheritance tax before we look at some of the others. Will inheritance tax relief for someone who died, say, 5 years ago, still be available on the death of their spouse?
That's what we're being told at the moment, and I would be surprised if that was going to be interfered with. Just so people understand, what any government, not just this one, any government publishes at the time on budget day is relatively brief details, and the legislation will not be available for some months. Probably there will be some discussions and things around it. So often you are reading quite a bit into maybe only a sentence or two, and so there is detail, but I would be surprised, and that would seem both unnecessary, and if you look at the money that's expected to be raised from this, it, they certainly haven't taken that into account in their figures.
No
So I
problem at
think
all. It's all
we've
good
got
stuff.
questions here about business asset disposal relief and furnished holiday lets, and saying if you dispose of it before the 6th of April 2025, will you get the 10% tax rate? Yes, you should, subject to meeting the qualifying criteria. Um, there's some, the devil's in the detail, but as long as you meet the qualifying criteria and you've sold, particularly if you've done a third-party arm's length sale, then no problem at all. Yeah, that one should be okay. Broadly, the business asset disposal relief this side of the 5th of April shouldn't be a problem. I'm just trying to scan down here. Some will be, one or two comments of some people that I think we will leave other people to, more, I think, probably get to perspectives.
Yes, there's one that caught
Yeah.
my eye, John, because I know this is a subject close to your heart. Furnished holiday lets. The question about the furnished holiday lets status or regime due to
Yeah,
be abolished next year. Does the capital gains
yeah,
tax rate of 10% still apply until then?
which was the one I was, so what I was trying to say there is yes,
Sorry.
it will, as long as it's
Right.
an arm's length sale and it kind of goes
Okay.
through, that should be okay.
Okay, you've dealt
So
with that.
just going down,
Employment allowance.
I think we just need to see
We've
whether
covered that.
where the detail comes through. I mean, I think my feeling is the difficulty for most of our, you've got small businesses where the employment allowance will make a difference, but for a lot of our clients, it will just be, if I say irrelevant, that's probably slightly unfair, but not significant. Yeah, okay. So there's a question here, somebody asking what's going to happen on self-invested personal pensions and who pays the tax. The consultation document, or the documents issued by the government yesterday, the first question they pretty well said is, how do we get this to work and who pays the tax? So, I think there's quite a lot, which is why the inheritance tax one is pushed further out to 27 from memory. I mean, do you think there's a likelihood of more businesses considering offshoring as a result of increasing business tax? Yes, I think that continues to happen, as will just automation. Somebody asking about holdover of business assets still there. Yes, there's been no changes that we've seen to any holdover. So you've got 165 holdover for transfers to individuals, where you've got a transfer to a trust, and you've got a different type of holdover, which is slightly more generous, but caught by different rules. There are restrictions on some of that holdover. The holdover will apply to agricultural property. So one of the things that farmers in particular are in a strong position on is they've got far more generous treatment of the ability to pass on assets than most other businesses have. But they will go across at their current value for capital gains tax purposes. So there is a latent gain being passed on. But if the intention is to keep an asset in the family long term, then you might just decide that's livable with. I didn't touch on the changes to SDLT that someone's asking about. There's a very good blog on the website, which is probably where I'd direct someone to. So that looks reasonably chunky in terms of the extra tax being raised on the surcharge on second homes. We do quite a bit of planning already around trying to make sure that we can, selling assets within a time period to a company or something like that to try and get the surcharge back. And the ending of we'll call it the SDLT holiday, whereby for first-time buyers or the higher starting threshold, it's all just deeply unhelpful. SDLTs are not very nice tax at all, and it doesn't feel like we're heading in the right direction. Yes, a farmhouse can come within the residence nil rate band, is one that someone was asking about. Yeah, I mean, there's a lot of observations by people like hotel owners and care homes, and I think all of these comments are very reasonable, and they're ones that I can only sympathise and people need to absorb the information, take advice, and consider what they are doing. What I was trying to give some impression of is that there is quite a lot that people can do. So please do not be completely despondent. What is the right thing to do needs to be tailored to people's individual circumstances.
Yes, of course, John. That's a good point to make, as always. And yeah, thanks very much to everybody for all your questions and comments. Apologies we haven't had time to pick those up here on the webinar, but we will be able to get back to you hopefully offline if we have your contact details. As John said, we haven't even had time to touch on the stamp duty land tax changes, but our colleague Victoria Hudson has written a very clear and helpful blog that you can find on our website. We've also got blogs on, we've got an overview piece from John, if you haven't read that yet. As I mentioned earlier, Steve York's written a blog about the changes to capital gains tax and inheritance tax. Do check that out. Steve Ashworth and Joe Rousel have written about the national insurance changes and the living wage increases and the pressure that that puts on employers. Rhiannon Bainham has taken a look at the corporate tax roadmap published yesterday alongside the budget. Again, we haven't had time to go into that here, but please do take a look. I mentioned earlier Youssef's blog about carried interest and the changes affecting non-doms. Some people may be interested in taking a look at that. And Mark Bishop and Kirsty Martin have updated our content on the VAT on private school fees. So again, please do take a look if that is of concern to you. So yes, as I said, lots more budget analysis on our website. There'll be more coming out in the coming days and weeks. So if you aren't already following our LinkedIn page, please do. And then you can see the latest updates and insights as we publish them. John, thanks very much for your time and your insights today. Were there any sort of closing thoughts that you wanted to end on? I mean, this is the first budget for a new chancellor. Rachel Reeves was very keen to portray it as a sort of clearing the decks, wiping the slate clean sort of budget. But you know, looking ahead to the next 5 years, what do you think the direction of travel is likely to be?
I said we're going to end up being chirpier. My concern is that there's still going to be a desire to try and raise some more money, and that some of these things will come back to and try and raise some more money. So I enjoy our chats on this, Gordon. Thank you very much. It's been enjoyable talking to you. I am feeling a bit old for some of this, and it would be nice if there was some more positive and good news, and let's hope that businesses can be a bit more supported going forward.
Likewise. Well, thanks, John. Very enjoyable and interesting as always. I hope you, our audience, have found it interesting and useful as well. Thanks very much for taking time out of your day to be with us, and we look forward to seeing you again in future. Goodbye.